Okay, so just yesterday, the financial world felt this massive jolt. The Dow just soared, a new record high, right? Exploded over 800 points.
Yeah, quite a day.
And it was all apparently thanks to some, carefully chosen words from Fed Chair Jerome Powell. He used this key phrase, conditions may warrant adjusting our policy stance.
Mm-hmm. That phrase definitely got attention.
But what does that actually mean? I mean, for your investments, maybe your career, the whole economy, and how does it all connect to this sort of whirlwind of changes we're seeing right now?
It's a classic case, really, of the market just hanging on every single word. And the implications, well, they truly ripple far and wide, affecting everything from, global trade right down to your local store.
Absolutely. So today we're doing our deep dive into a whole stack of your sources. We're looking at the intricate world of chip manufacturing, corporate strategies trying to grapple with tariffs.
And also the nitty-gritty personal finance stuff, like student loan repayments starting up again, how you send money internationally these days.
Yeah, and even kind of surprisingly, the cultural impact of a brand's new logo, if you can believe it.
Right.
So our mission here is to connect these headlines that might seem, totally separate. We want to pull out the most important insights and really help you understand the forces shaping our economy right now.
Think of it as maybe your shortcut to being genuinely well-informed about this complex dance between policy, what companies are doing, and, your everyday financial life.
Exactly. We'll explore how these big stories directly impact, say, your investments, your job prospects, even the cost of stuff you buy. Hopefully you'll have some aha moments because we're going to unpack some truly fascinating developments.
Sounds good. Let's get into it.
Okay, let's jump right in, though. Yesterday, Fed Chair Jerome Powell, speaking at Jackson Hole, he used that phrase we mentioned, and it sent markets absolutely soaring. Conditions may warrant adjusting our policy stance. What exactly was the market hearing there? Why such a, explosive reaction?
Well, the market processed that statement, like lightning. Powell's words were seen as signaling a potential pivot, right, towards interest rate cuts, specifically hinting at maybe a 25 basis point reduction.
From the current range.
Exactly,
Yep.
from the current 4.25%, 4.5% range. And futures traders almost instantly priced in, I think it was close to a 90% chance of a cut happening as early as September.
Wow.
Yeah. It's a pretty significant shift away from that very restrictive stance they've had. It just injected this huge dose of optimism.
And the reaction was, like you said, immediate, just dramatic. The Dow surged over 800 points, hits a record high. The S&P 500 climbed a healthy 1.5%, NASDAQ up almost 2%. And you saw all the big tech names, NVIDIA, Meta, Alphabet, Amazon, Tesla. They all jumped significantly. It really felt like a day of just pure market euphoria.
Yeah, it did. But while the market was definitely celebrating, it's really crucial to remember there's still a significant internal debate happening within the Fed.
Right, it's not unanimous.
Not at all. You have Cleveland Fed President Beth Hammack, for instance. She expressed some, strong hesitancy. She pointed out that inflation's been above their 2% target for 4 years now.
4 years, yeah.
So she's emphasizing the need to maintain what she called a modestly restrictive stance to avoid, quote, reinvigorating inflationary pressures.
Yeah.
And you also heard skepticism from Kansas City Fed President Jeffrey Schmidt. So it really highlights this tug of war happening inside the Fed.
And Powell himself, he didn't completely ignore the challenges, did he? He acknowledged these sweeping changes in tax, trade, immigration policy,
Yeah.
and specifically mentioned how tariffs, those themselves, add a real risk for inflation.
Exactly.
So you've got these dissenting voices, you've got this known tariff risk. Is the market maybe getting a little ahead of itself here? Is that euphoria maybe premature?
That's really the core question, isn't it? While the market is certainly celebrating the potential for cuts, the Fed is still grappling with this really complex environment. Trade policies could fuel inflation, and some policymakers are just, wary of moving too fast.
Understandably.
Powell himself gave what he called a painful reminder of the hardship that high inflation imposes. So for you listening, this isn't just about stock prices going up and down. It's really about the cost of borrowing money, right?
Right.
What you earn on your savings, the stability of the prices you pay every single day. It's this constant, delicate balancing act.
And it wasn't just the traditional stock market bouncing either. The crypto market also had a pretty strong reaction. ETH, it surged nearly 14% to over $4,800. That's getting close to its 2021 all-time high. Bitcoin rose too.
Yeah, that's pretty typical of what they call a risk-on mode for investors. When the Fed signals potential easing, looser money, that money often flows into what are seen as riskier
It's
assets.
like crypto.
Exactly. And we saw about $120 million in short liquidations for ETH in just 1 hour around Powell's speech.
Wow, 120 million in an hour.
Yeah, essentially that's a wave of forced selling by people who were betting against Ether. And that just further amplified the price jump. But, it's still a really volatile space. While there was a one-day inflow for Ether ETFs, those are the exchange-traded funds tracking Ether's price.
Right.
Both Ether and Bitcoin ETFs were actually on pace for record weekly outflows. So that suggests there's still some underlying caution despite that one big surge.
Okay, so from those immediate market reactions, let's zoom out a bit. Let's talk about a longer-term economic play, one with enormous implications. This massive push to bring critical chip manufacturing back to the U.S.
Yeah, this is huge. A crucial takeaway here is Texas Instruments, TI. They're undertaking this colossal $60 billion manufacturing mega project spanning Utah and Texas.
$60 billion, that's a massive investment.
It's enormous. And what's more, Apple has made a significant commitment. They plan to make critical foundational semiconductors, think iPhones, other devices at these new TI fabs. This is part of Apple CEO Tim Cook's bigger commitment to increase U.S. spending to $600 billion overall.
And this isn't happening in a vacuum, right? There's a clear political backdrop. President Trump announced those 100% tariffs on chips from companies not manufacturing in the U.S.
Yeah.
That seems like a pretty direct catalyst here, basically rewriting America's industrial map.
Oh, absolutely a catalyst. Now, it's important to note TI doesn't make the absolute, bleeding edge chips. Their focus is more on the 45 to 130 nanometer range compared to, say, 2-3 nanometers from TSMC.
So not the super advanced ones, but still essential.
Exactly. Their analog and embedded chips are absolutely foundational. They're in, well, the source says anything that plugs into the wall or has a battery in it. So basically everything.
Right.
And TI is making what they call a big bet here to regain market share. They're leveraging the cost efficiency of these larger 300 millimeter wafers. And this whole effort, it benefits massively from government support, too. We're talking $1.6 billion in GPS Act funding,
Okay.
a 35% investment tax credit, plus state and local incentives. It's turning places like Sherman, Texas, into what some are calling the Silicon Prairie.
Silicon Prairie, I like that. And speaking of government partnerships in the chip sector, Intel is another huge piece of this puzzle, right?
Indeed. Intel shares actually rose recently after reports that the Trump administration is looking to take a 10% non-voting equity stake in the company.
A stake in Intel from the government.
In exchange for SHLP TS Act funds. Yeah, it
Yeah.
signifies a really distinct shift in U.S. industrial policy. You're seeing the government taking a much more active, direct role in corporate America.
That is a big shift, especially since Intel is technically the only U.S. company capable of making the most advanced chips domestically, even if they are currently lagging behind competitors like TSMC.
Right. But what's striking here is this sort of tension between the long-term vision and the current realities. Intel's big Silicon Heartland project in Ohio, which was supposed to produce those advanced chips, well, they're actually slowing down construction now.
Oh, really? Why?
Operations aren't expected until 2030. It seems influenced by market conditions, but also internal memos talking about no more blank checks. So it shows that even with government backing, these huge mega projects face real headwinds, and financial discipline still matters.
Okay, let's transition now to another industrial giant, but one facing its own set of pretty significant challenges. John Deere.
Deere is definitely seeing weaker demand right now, especially in the agricultural sector. That's leading to, significant drops in their net income and sales.
And unfortunately, layoffs too, right?
Yes, hundreds of layoffs recently, adding to thousands over the past year. It's a tough time for them.
Well, they're driving that downturn.
It's really a confluence of factors. You've got rising costs, the impacts of climate change on farming, labor shortages, and also lower crop prices. All of this means farmers are pulling back on buying expensive new equipment.
Makes sense.
And on top of that, the company estimates a pretty substantial hit from tariffs, around $600 million in fiscal 2025.
$600 million just from tariffs. Yet, despite all this short-term pain, Deere is committed to this massive long-term strategy. They've pledged to invest, $20 billion into U.S. manufacturing over the next 10 years?
That's right, $20 billion. And that move was partly influenced, reportedly, by President Trump's threats of potentially 200% tariffs if production moved down to Mexico.
So policy pressure playing a direct role again.
Clearly. Interestingly, Wall Street analysts seem generally optimistic still. They mostly believe 2025 will represent a kind of bottoming out for the company. But it really shows you how government policy, global trade dynamics, they're directly impacting manufacturing jobs, long-term investment decisions, even in sectors as different as agriculture and high tech.
It really underscores that interconnectedness you mentioned earlier. Companies like Deere, they're navigating this tough current market, but at the same time, they're responding to policy signals and making these huge long-term bets on domestic production.
Yeah, you almost wonder how much is strategic choice versus just reacting to the political and global pressures they're under. It's a fine line.
Okay, now shifting gears again, let's talk about something that impacts, your everyday shopping cart. How are the big retailers handling this waves of tariff increases? Are we seeing prices go up everywhere?
Well, what's interesting is how retailers like, say, Walmart, Home Depot, even Coach, they are seeing rising tariff costs, but they're getting pretty creative to try and avoid just passing it all directly on to consumers through widespread price hikes.
How are they doing that? Getting
Yeah.
creative how?
Well, several ways. They seem to be absorbing some of the costs themselves, eating into their margins a bit. They're also actively diversifying their sourcing, trying to buy less from China and more from other countries. And in some cases, they're pushing back on their vendors, trying to get them to share the burden of the tariffs.
So a mix of strategies.
Exactly. Walmart's CFO, for instance, noted they've absorbed some impacts, but they've also had to pass some along. It's always this balancing act for them, trying to keep prices low for shoppers.
And are we seeing any changes in how people are shopping because of this?
Yes, there are signs. While overall consumer spending seems generally steady, there are definite indications that lower-income shoppers are showing more price sensitivity. You see that reflected in things like buying more private label or store brands at Walmart, for example.
Okay, that makes sense.
And you get these interesting contrasts, too. Like Coach apparently had a $695 handbag, the Kisslock bag, that sold out quickly. So resilience maybe in higher-end spending. But then you have Crocs reporting that their customers are being super cautious and orders are weak. And Home Depot, they're actively working towards a goal of importing no more than 10% of their goods from any single country by the end of the year, specifically to mitigate these kinds of risks.
Trying to de-risk their supply chain.
Precisely. And then there's still this ongoing uncertainty with the 90-day delay on those higher China tariffs. That just adds another layer of complexity for these companies trying to plan and navigate what feels like a pretty unpredictable landscape right now.
Okay, let's bring it even closer to home now. Something that could directly affect millions of people's bank accounts, possibly starting later this summer. Student loan collections.
Yeah, this is a big one. The Trump administration is indeed set to resume student loan collection efforts. That includes wage garnishment. The timeline given is later this summer.
No specific date yet, though.
No specific date revealed, but it's coming. And we're talking about over 5.3 million borrowers who are currently in default. So this is a really significant change after, 5 years of paused collections during the pandemic and after?
Okay, so what does this actually mean for you if you happen to be in default? And maybe more importantly, what can you do about it?
So the U.S. Department of Education has the power to garnish up to 15% of your disposable pay. That's the key part, disposable pay.
15%.
However, there's a protection. You must be left with a minimum weekly income, which is currently set at 30 times the federal minimum wage, so about $217.50 per week.
Got it.
It's also worth noting it tends to be harder for the government to garnish income if you're a 1099 worker, like a freelancer or contractor.
Right. So what's the crucial advice here? What should people do now?
Act now. That's the main thing. Borrowers should receive a 30-day notice before any garnishment starts, and you have the right to challenge it. You can request a hearing, or you can try to prove financial hardship. But honestly, your best bet is probably to be proactive. Contact the government's default resolution group immediately, like right now. Get enrolled in an income-driven repayment plan, or look into loan rehabilitation before the garnishments potentially start and before their phone lines get potentially flooded with calls.
Avoid the rush, basically.
Exactly. Avoid the rush, get ahead of it. And one piece of good news, your employer cannot legally terminate you just because your wages are being garnished for student loans.
That's important to know. So definitely a heads up for potentially millions of people there. Understand your options. Act quickly.
Absolutely critical.
Okay, switching gears again. If you're one of the, estimated 20 million Americans who regularly send money overseas to family or friends, this next bit is definitely for you.
Yeah, the whole landscape of international money transfers has just been fundamentally reshaped by digital apps. It's made things so much easier, faster, and often cheaper than the old ways, like, getting a money order or doing a traditional bank wire.
Oh yeah, bank wires can be expensive, right?
Yeah,
Like $40, $50 just for the fee.
easily. And then they often have hidden exchange rate markups, maybe 3 to 6%, that really eat into the amount received. And interestingly, those popular apps we use domestically, like Venmo or Zelle, they generally don't even work for international transfers.
Right, I didn't realize that about Venmo and Zelle, so it really is a different set of tools for sending money abroad.
It is, and it's become this digital revolution, really. When you're choosing an app now, you'll find different ones kind of excel at different things.
So what are some of the top options people might look at?
Well, the sources highlighted a few. Remitly was mentioned as being good for low fees. They often waive the fee on your first transfer, and they offer flexible delivery, like cash pickup or even home delivery in some countries.
Okay.
Wise, formerly TransferWise, is often noted for offering the mid-market exchange rate with basically no markup. Plus, it lets you hold balances in over 50 different currencies.
That's useful.
For really large transfers, OFX could be a strong contender. They apparently have no maximum transfer limit and no transfer fees for U.S. customers sending money out.
No limit. Okay.
And then you still have the old stalwarts, Western Union and MoneyGram. Their strength is really that global availability and the widespread options for cash pickup, which is still crucial in many parts of the world.
True.
And one more, Zoom, which is owned by PayPal. Its main advantage is convenience, especially if you already use PayPal. It integrates right in, and interestingly, it even allows you to use cryptocurrency to fund your transfers now.
Using crypto, huh? That's new.
Yeah. So the bottom line is choosing the right app really depends entirely on your specific needs. You need to prioritize what matters most to you. Is it the lowest fees, the absolute fastest speed, coverage in a specific country, or maybe those delivery options like cash pickup? Thinking that through helps you get the most for your money.
Makes sense. Okay, let's switch to something maybe a bit lighter, but still, I think, incredibly relevant to how businesses connect, or sometimes disconnect, with their customers. Let's talk about Cracker Barrel.
Ah, yes, Cracker Barrel. They recently faced some pretty significant social media pushback over their new logo and this broader brand refresh they undertook.
Right, I saw some of this online. Describe the change again.
So the old logo, is very distinct, had the man leaning on a barrel, the phrase old country store right there.
Yeah.
Very nostalgic. The new one is much more simplified, just the words Cracker Barrel on a yellow background, with some other colors apparently inspired by eggs and biscuits.
Eggs and biscuits, okay. And the reaction was not positive.
Not universally, no. The criticism online was pretty intense. You had users calling it soulless, bland, generic, just really stripping away the character they associated with the brand.
Yeah.
And then the backlash kind of escalated, didn't it? It got picked up in conservative circles with figures like Donald Trump Jr. and Robbie Starbuck amplifying it and somehow linking this redesign to, wokeness.
It seems like a stretch for a logo change, but okay.
Right. And then, perhaps even more surprisingly, the official Democratic Party X account, their social media, also jumped in to criticize the change. So they managed to get criticized from sort of both ends of the spectrum there.
Wow. Talk about getting it wrong for everyone.
Right.
So what was Cracker Barrel trying to achieve?
Well, the company stated its goal was basically to maintain that feeling of country hospitality, but appear, in their words, lighter, brighter, and more welcoming, maybe trying to appeal to a slightly younger or broader audience. But clearly, it struck a nerve with their loyal base, and apparently, customer complaints also extended to some interior redesigns they were doing in the stores, too.
Huh.
It's really a powerful lesson, isn't it, in how modern brands have to navigate this kind of cultural minefield. A seemingly innocent refresh, like a logo change, can just ignite a social media firestorm.
Yeah, we've seen that before.
Absolutely. Think about American Eagle, Bud Light, other companies that have seen their stock prices swing based on these kinds of political or cultural social media posts. It shows that for some consumers, brand identity isn't just about aesthetics anymore. It's tied up with deeply held values, maybe nostalgia. And that can directly impact a company's valuation in today's, very online digital age.
Fascinating stuff. Okay, finally, let's look at a really interesting and maybe somewhat concerning trend emerging in the job market.
Yeah, this one is quite counterintuitive. Usually, the pattern we expect to see is that job switchers, people who change jobs, they typically experience faster wage growth than job stayers,
Yeah.
people who remain in their current roles. That's been the norm for a long time.
Right, you switch jobs to get a bigger raise, basically.
Exactly, that's usually the incentive. However, for the past 6 months now, going back to February, this pattern has completely reversed.
Reversed. How so?
Job stayers' wages, people staying put their wages, have actually grown faster, about 4.1% in July, than job switchers' wages, which were at 4%.
Wow, that is unusual. How rare is that?
It's pretty rare. The sources say it's generally seen as a signal of some underlying weakness in the labor market. It's a trend that you typically only see around really difficult economic periods, like the Great Recession or maybe the dot-com bust era, so it definitely suggests a significant shift is underway.
So what are the implications of that? If staying put pays better than moving, what does that mean?
Well, one striking aspect mentioned is the implications for worker behavior. That whole trend of job hopping that was so prevalent recently seems to have been replaced by more job hugging.
Job hugging?
Yeah, people clinging to the jobs they have. This is happening as job openings have fallen from their peaks, and employers are apparently hiring now at the slowest pace in over a decade.
Okay, so the leverage is shifting.
It seems workers have lost some of that bargaining power they had maybe a year or two ago. And the quits rate, the percentage of workers voluntarily leaving their jobs, is now at its lowest level since early 2016.
Lowest since 2016.
So this isn't just some abstract economic statistic, right? It directly affects your career decisions, your negotiating power when asking for a raise, and maybe just how secure you feel in your current role. It really suggests that while the overall aggregate labor market might still look strong on the surface,
Like low unemployment.
exactly, like low unemployment,
Yeah.
there are these subtle but really significant shifts happening beneath the surface, and they're reshaping the employment landscape for a lot of people.
Okay, quite a journey we've taken today. We've navigated this really complex landscape, haven't we? From the Federal Reserve trying to do that delicate balancing act with inflation and interest rates.
Right, to corporations making these huge multi-billion-dollar bets on U.S. manufacturing, all happening in this tariff-heavy world.
And even the surprising cultural impact of social media backlash on established brands like Cracker Barrel.
We also dug into some really critical personal finance updates. That heads up about looming student loan garnishments, new ways to send money globally.
And finishing with that really curious, counterintuitive shift in wage growth, changing how we might think about career progression and job security right now.
Yeah, a lot of ground covered.
What's truly fascinating, I think, when you pull it all together, is just the sheer interconnectedness of everything we talked about. A few carefully chosen words from the Fed chair can send crypto markets soaring, while a tariff policy directly influences where the chips inside your iPhone are actually made.
And a corporate brand refresh ignites these cultural debates that can actually hit a company's bottom line, while these subtle shifts in the labor market start redefining people's career strategies.
Exactly. So as we look ahead, it makes you wonder, right? How will these interwoven threads, policy, corporate pivots, this evolving consumer sentiment, how will they continue to shape not just our financial markets, but the very fabric of how we work and how we spend our money?
Yeah, and what are the implications of this constant state of adaptation for innovation, for resilience, and maybe most importantly, for your own personal financial journey in the years to come?
Definitely something to mull over as you continue your own deep dive into the world around you.